The most dangerous illusion the West ever believed was not about an external enemy, but the idea that a strong currency automatically means a strong nation. And that belief blinded them to a counterintuitive strategy quietly reshaping the global economic order. Because if a weak currency can function as a weapon, then China has wielded it as a long-term geopolitical tool for over 3 decades. In the late 1970s, China emerged from the Cultural Revolution impoverished, industrially backward, and largely isolated from the global economy. When Deng Xiaoping launched reforms in 1978, the objective was not monetary prestige, but survival, factories, jobs, and foreign currency. Without dated technology and low-quality goods, China could not compete on innovation or branding. It had to compete on price. But achieving ultra-low prices at a national scale required more than cheap labor. It required control over the exchange rate. At an exchange rate of 5 yuan per dollar, a 25 yuan shirt would sell abroad for $5, hardly compelling against Mexico or domestic U.S. production. But if policymakers suppressed the rate to 8 yuan per dollar, that same shirt would cost just over $3, instantly transforming global competitiveness. Western retailers, driven by profit margins, shifted production and supply chains toward China at unprecedented speed. Under normal market logic, surging exports and rising dollar inflows should have strengthened the yuan. Yet the People's Bank of China refused to let appreciation occur. Each time exporters converted dollars into yuan, the central bank printed additional domestic currency to absorb the incoming dollars. The result was a dual effect. Persistent yuan oversupply kept the currency weak, while dollar reserves accumulated at historic scale. A massive circular capital system began to take shape, and this was only the opening move of a much larger strategic game. By holding its currency down, China did more than boost exports. It accelerated industrialization at a speed the West took a century to achieve. Foreign corporations did not merely buy products, they transferred blueprints, machinery, management systems, and technical expertise. Instead of reinventing every technology from scratch, China imported entire production ecosystems in exchange for short-term profit opportunities. Cheap currency acted as a magnet for foreign direct investment, pulling global capital into newly built industrial zones across the country. Hundreds of millions of rural workers moved into factories, becoming one of the largest trained industrial labor forces in human history. Meanwhile, manufacturing towns across parts of the United States and Europe experienced factory closures, job losses, and structural decline. The trade imbalance widened, and dollars flowed into Chinese banks at unprecedented scale. By 2014, China's foreign exchange reserves approached $4 trillion, forming the largest reserve stockpile the world had ever seen. But China did not simply store those dollars. Idle capital is wasted capital. A significant portion of those reserves was reinvested into U.S. Treasury bonds, effectively financing American government deficits. The system became circular. American consumers bought Chinese goods. China accumulated dollars. Those dollars were used to purchase U.S. debt. The United States then used borrowed funds to sustain public spending, which in turn supported continued consumption of imported goods. Manufacturing capacity migrated eastward, while financial obligations accumulated westward. What appeared to be mutually beneficial trade concealed a profound shift in productive power. And beneath that shift lay a generational sacrifice inside China itself. The weak currency strategy was powerful, but it carried domestic costs that were rarely discussed outside China. Suppressing the yuan reduced Chinese consumers' purchasing power, making imported goods artificially expensive. Workers producing global electronics often could not afford the very products they assembled. Export dependence also distorted economic balance, prioritizing investment and infrastructure over household consumption. As skyscrapers and highways multiplied, income inequality widened and internal demand lagged behind industrial output. Continuous monetary expansion to absorb foreign currency increased domestic liquidity and financial risk. Excess capital flowed heavily into real estate, inflating property markets and contributing to speculative bubbles. Empty housing developments and rising internal debt signaled the structural side effects of rapid growth. Chinese policymakers understood these trade-offs, but viewed them as acceptable sacrifices for long-term strategic capacity. Unlike short electoral cycles in Western democracies, Beijing operated on multi-decade planning horizons. By the mid-2000s and especially after 2010, China gradually allowed the yuan to appreciate. This shift was not capitulation but recalibration. By then, the manufacturing foundation had already been secured. Integrated logistics networks, advanced ports, high-speed rail, and dense supplier ecosystems created powerful structural lock-in. Even with a stronger currency, multinational corporations struggled to replicate China's supply chain efficiency elsewhere. The ultimate lesson is clear. National strength is not measured by currency prestige, but by control over production capacity and technological leverage.